Hey everybody, welcome to an episode of This Week in Real Estate. This is episode, where are we at? 279. Wow, we've been out here, y'all. Thanks everybody for joining us. We're broadcasting live everywhere today but LinkedIn. For some reason, LinkedIn is not playing right with StreamYard. So if you were hoping to catch it on LinkedIn, I'm gonna have to move you to YouTube. Go there. If you're live with us on YouTube, you could comment on YouTube and I can display your comment and talk about you, or I can talk about your comment. There's Olivier. He said, honey, I shrunk the house. That's exactly right. We've actually done a story like this before and I used that as a thumbnail, but today's thumbnail is a little bit different. We are going to talk about why is your house shrinking? What the heck is going on? And are markets 40% overvalued? That's what we're going to be talking about today. If you're watching on Facebook, you can also comment from Facebook and usually LinkedIn. But like I said, for whatever reason, we're not there. And we're also on Instagram. What's up, Instagram fam that are joining us? I see you over there. You can comment there and I'll just try to say your Instagram name, though it shows really small on the screen. But I'll try to say your Instagram name and what your comment was, but I can't display it. But thanks everyone for joining all over the world. We're also in Clubhouse. We're in the largest real estate networking group in the world in Clubhouse, and we're broadcasting live there as well. So if you're in Clubhouse and you want to join the conversation, just raise your hand. As long as you have an actual bio and are a real person, one of the moderators will bring you up and we'll add you to the conversation. Everything you say can and will be held against you because it is going to be recorded and added straight to the podcast, so I don't edit it. So thanks everyone for joining us this week. Like I said, kind of in the pre-show for the Clubhouse folks, last week I felt like we had no news to cover. This week, I feel like we have a ton of news to cover, and I'm kind of curious if we can even get to it in time. So without further ado, I'm just going to jump right into it. So first up, oops, that's the wrong display. First up is the DOJ filing. Y'all remember the whole thing with Rex? Rex was this website that people could go put their home on for sale by owner. And Rex had promised that if you did that, they would also send it to all these other third-party websites like Zillow. I don't know if Realtor was on there, but the third-party website people. Well, what Zillow did was they became a brokerage. And when Zillow became a brokerage, they had to abide by the IDX rules. And the reason why Zillow became a brokerage is because there was some talk about cutting them out of all the IDX feeds. Well, you can't do that if they're a brokerage. So Zillow became a brokerage. And there's a stipulation that NAR has that said you can't commingle listings that are listed on the MLS with other listings, like MLS listings or listings that are off market. For sale by owner listings, I'm sorry. You can't commingle MLS listings with for sale by owner listings. So Rex, that was kind of their MO, is that that's what they would do. So Zillow said, well, we're going to put you guys on a different tab along with all the other people that list their home themselves. So we have the MLS listings over here. Then we have the Rex listings on their own tab over here. Well, for whatever reason, there were a lot of politicians that came out on behalf of Rex, and a lot of them were Republican, which it's pretty well known to viewers of the show. I'm fairly conservative, but that was a big thing I didn't agree with, was their stances on how they were treating Rex. But there was a ruling. Court case went through that said Zillow was not doing anything wrong. And it was our contention at the time. If you guys remember Dan and I talking about this, if you were building a business on someone else's platform and that platform changes, you can't really be upset about it and go after them because it was your fault for relying on that other business. So Rex's business model was relying on all of the exposure they would get by listing on Zillow alongside of the other MLS listings. Well, the DOJ is jumping in and saying, in the words of Lee Corso, not so fast. So the Department of Justice filed an amicus brief on June 20th, 2024, urging the Ninth Circuit Court of Appeals to reconsider its ruling on the case between the Real Estate Exchange, REX, and Zillow earlier this year, a ruling that ultimately benefits the National Association of Realtors. As the DOJ argues in the filing, the ruling judge took a, quote, incomplete approach that creates risk, and associations like NAR could evade antitrust scrutiny with, quote, optional rules. So what NAR has said is that the rule about commingling was optional. But what Zillow said is that they had to abide by that rule due to the IDX feeds. So let's see. As a discount brokerage, real estate exchange bypassed the MLS, opting instead to promote its listings on Zillow and on social media and in search. To keep commissions low, REX attempted to bypass the MLS to avoid mandatory buyer, broker, and agent compensation that NAR required for its affiliated MLSs. Now that's going to be weird because I don't know that this case is even a case anymore. If that's gone, I guess they could sue for damages done in the past. That's probably what they're going after there. Zillow separated its MLS and non-MLS listings to maintain access to the IDX data, which we just talked about. So the ruling was in favor of Zillow. So it says optional in name, mandatory in practice. In complying with NAR's commingling policy, Zillow aptly demonstrated NAR's power in the industry to effectively mandate compliance with the rule that limits competition from non-MLS listings. So in regard to the DOJ following, NAR issued the following statement. NAR continues to believe the lawsuit is without merit, and the district court's determination on the summary judgment that there was no antitrust violation should be affirmed. The spokesperson for Zillow said Zillow was founded on increasing transparency in real estate, and we have long history advocating for consumers through our products and services. We were required to comply with the no commingling rule to obtain our IDX feeds. Quote, bold, but we've publicly advocated against this rule for several years because we believe the listing data should be displayed in one place. We look forward to the jury's verdict and the judge's ruling to be affirmed. So it's interesting. NAR is saying, we want to keep this in place, so affirm the ruling. Zillow is saying, we had to do this, so affirm the ruling. So both of them are saying affirm the ruling, but Zillow is saying that they're actually against the mandatory IDX rule. So REX failed to persuade a Seattle jury in January. That was the last time that we talked about this, I think. They said it was without merit. Now the DOJ has come forward in disagreement with that decision, arguing for a reconsideration. So essentially, here it says, with that, he effectively removed the National Association of Realtors as a party to the case. So essentially, the DOJ is trying to bring back the NAR as a party to this case, saying that Zillow was forced to do this from the NAR, so the NAR is the one who should be sued in this and not necessarily Zillow. Interesting. As I said at the onset, this whole Rex thing is very political. And it's really interesting to see the different sides people take. It seems like there were a lot of Republicans that were on Rex's side and a lot of Democrats that were on the NAR side. And I don't know if that had to do with donations or money or whatnot, but that's just what it seemed. I think maybe even some Republicans had a stake in Rex, but I may be misspeaking there. Like Chris Christie came out throwing his weight, pardon the pun, behind Rex. I really didn't mean to make that fun. That was a good one. So Chris Christie came out kind of anti real estate agent there. So we'll wait and see what happens on that one. More Rex drama. And I'm curious if they're just going to say, well, none of this is valid anymore because the whole buyer, broker, agent compensation rule has changed anyway. So, and if that happens, then, I mean, I guess I don't know. Do they have to go back to square one on some of these lawsuits and figure out actually, moving forward, it's all changed. So now we're just suing for what's happened in the past. How are you? Delcinia Jones. I haven't seen you in a minute. She said, was it the DOJ quiet prior to 2020? It was pretty quiet. There wasn't a lot of activity towards real estate agents during that time. And it has seemed to increase recently, you could say. What's up, Cameron Cohen? Cameron likes my throwing the weight joke over on Instagram. All right, so there's another. There's more, but wait, there's more. And like I said, we may have to go rapid fire today. Judge denies stay order after plaintiffs argue against the NAR deal. So this was another one where people are coming out against the NAR deal, saying that they want a different deal or more money or whatnot. This one was for the attorneys for the plaintiffs in the case known as Mortis. Stress that NAR's proposed settlement won't stop a key element of the antitrust conspiracy and might take years to go into effect. A federal judge rejected a request to pause legal proceedings against the broker-owned multiple listing service after plaintiffs argued that the settlement deal with the National Association of Realtors would not stop a key element of the antitrust conspiracy. This is the West Penn MLS situation. The stay would have temporarily stopped West Penn MLS's obligation to respond to the class action lawsuit, followed by the home sellers in December. So this case is known as the Mortis. The suit alleges West Penn MLS Commission's related rule violates the Sherman Antitrust Act, just like all the others, kind of. Nationwide collusion. If the motion for final approval of the Burnett settlement is granted following the fairness hearing of November 2024, all individual and punitive class claims against WPML in the instant case will be released. So, all right, so you guys can read more on that. That's on Inman. It's just more activity on the lawsuit, more delays too. It seems like they can't get this thing wrapped up, even though the settlement has gone through and has been approved. It seems like everyone is still after them to do something. And
MLS Pin also just got a stay.
They did get a stay,
which is
Now that's when did that?
Pending
I
the
didn't
settlement.
see that. I didn't see that one.
2 days ago.
Okay, that one wasn't on my feed for some reason.
Pending settlement.
Now MLS Pin. No. It was NW. It's hard to keep track of all the MLS names, but I believe it was the Washington MLS that came out against the ruling and said they weren't going to make any changes. A lot of the broker owned MLSs are the ones that are being forced to make the changes because the association is making changes, and if their association's making changes, then they also have to. We have more information on Colorado coming up too. So, but the DOJ has also been active in taking a look at some of these buyer broker agreements. So the DOJ inquiry delays a settlement-related document rollout at California Association of Realtors. California was supposed to release their documents related to buyer broker agreements, and they didn't. And there was just a note that said there was an inquiry into the agreement that halted them from releasing the document. So the inquiry was from the Department of Justice. California Association of Realtors this week delayed a rollout of nearly 24 new forms dealing with the NAR Commission suit settlement after getting an inquiry from the U.S. Department of Justice. Out of an abundance of caution, CAR is postponing the release of the 21 of those forms, which are associated with the changes in business practices required by the NAR settlement. CAR has received an inquiry from the U.S. Department of Justice regarding these forms, as well as the extensive feedback from our members. We believe it's prudent to take additional time to consider the concerns comprehensively. Any Cali realtors that have seen this? Mike, have you seen the documents? Do you know what they're talking about? And what is your opinion on them if you have? But are you there? I don't know if you're there or able to speak, Mike, in Clubhouse. Yeah, he's here.
Which document are you talking? They've just released a bunch in June.
They said that there were
Which
21
one was it? I'm sorry.
forms. They're postponing the release of 21 forms, and it said based on agent feedback. So I assume you guys have seen the forms that are coming. No?
I have not.
All right. Well, I don't. How would they? I guess maybe they had some focus groups.
They usually have small groups. I think they test stuff out on.
I guess that makes sense. Well, they're not the only ones after this. There's a Watchdog group that also came out taking aim at the forms. Now, I thought that this is interesting. You haven't seen the forms, but here's a Watchdog group that has. So Watchdog group takes aim at California buyer rep agreements. There is one company's agreement, though, that they love, and you'll never guess who it is. Mia Zoll said they asked for your feedback. The California Association of Realtors asked for your feedback, Mia. All right, so this Watchdog group, a consumer watchdog group, put realtor organizations on notice Tuesday and said it was in touch with state and federal regulators about rules and documents it believes that stack the deck in favor of brokers and against buyers. The report comes at a time when the local organizations nationwide are updating forms that govern the real estate industry following the landmark litigation in recent months. They're basically saying that they aren't clear. They aren't clear to read. Oh, Mia said no, NAR asked for your feedback. Well, that's cool. Let me know how that goes. The Consumer Federation of America, CFA, has been evaluating industry buyer contracts over the past several months, and the CFA said in a statement on Tuesday that it learned many of the contracts are anti-consumer, but also found one that is understandable and much fairer to everyday buyers. They said that the one in California, California Association of Realtors, that was dated May 9th, they said that it disguised the obligation of the buyer to pay his agent, his or her agent. Let's use their agent. Well, I don't know it. It is virtually unreadable, she said. No layperson will be able to understand and appreciate the terms that they're truly agreeing to. Have you seen the buyer broker agreement, Mike? The one on May 9th? Probably not. Poor guy's out of the loop.
The most recent one. Shoot, I don't know the date. I've been using it. What was the question on it?
She said that it's not clear who's paying the buyer agent.
No, it seems pretty clear. I mean, there's multiple sections. You know what the buyer is promising to remunerate to you. And then what happens if the seller is offering up, and what happens with that extra. It seems pretty thorough. It's the one that's been out for a while.
Carr fired back at the CFA's criticism, saying the report was based on an outdated version of its buyer representation agreement, calling the critique misguided and absurd. It declined to share so this is interesting. The group said its latest form, its latest version of the form, which it declined to share with Inman, addressed many of the concerns noted in the CFA's report. It says, for example, the CFA says the form doesn't comply with the NAR settlement. That's wrong. So basically, the Consumer Federation of America came out and said, we're going to evaluate all these agreements. And they started looking at all the agreements, and they started looking at the outdated agreement. Come on, man.
So Carr sends about, 3 or 4 emails a day. So usually when I notice something's changed is when I'm in there filling it out. I'm like, wait, this is different. And then I'll look at the version, and, they're constantly updating stuff. So it's kind of tough to keep tabs.
I guess. Yeah.
This is so annoying.
You have like 800,000 agents in California though, right? So it's a lot. What were you going to say, Jack?
Is the consumer really going to end up ahead in this whole thing?
No. Well,
or is the Consumer Federation of America going to swing on a Tarzan rope with their cape and be the defender of the consumer? But I mean, again, a whole lot of change for the sake of change when it really wasn't that broken to begin with.
Yeah.
So this whole legal thing is so annoying.
Well, I think we're seeing the impact of politics on an industry and what it means for someone to get out there and say, hey, we're going to come out against junk fees. And then they make all these changes that aren't really doing anything. It's not really changing the price or how much somebody pays. It's actually increasing the burden of payment on the buyer in most cases. So it's not really a good thing, but that's the price we pay for them to be able to go out and say, we're decreasing jump fees. So
and the price that we pay for being the largest, the largest trade industry and all that. I guess I would be naive to think that it would be any different. Yeah. But it seemed to be going just well before. So stop Stop moving my cheese, please.
Who Moved My Cheese? Great book by Robert Kiyosaki.
That's right. That's right.
Okay, so this is interesting. They said that they love the EXP agreement. This lady did. She said the contrast between the CAR and EXP contracts could not be sharper. That is Stephen Brobeck, a CFA senior fellow. And I guess that's true, because if CAR is using, if CAR is saying they're using an old contract and they're using the new contract from EXP, then yeah, I mean, it's going to have the changes in it. Oh my goodness. All right. So that's, there's an incendiary headline with the truth behind it. So if you're visiting with someone who's about to buy a house with you and says, well, I heard that this Watchdog group came out against these contracts, you could say, oh my gosh, let me show you. No, it's an old contract. This is not the only tea that we have today. Here's one that I asked some of my friends in Colorado about. MLS buyout by private equity. ReColorado's surprise sale raises concerns. Okay, so ReColorado is the 16th largest MLS in the nation. Shelley Vincent, the vice chair of ReColorado, confirmed the decision, revealing that Denver Metro Association of Realtors, and SMDRA, the South Metro Denver Realtors Association, have agreed to sell ReColorado to a private equity firm. The deal could be finalized in a matter of weeks. So the interesting part about this to me is that the process began last December, allowing ReColorado to buy back its shares and become independent. And then she said, but we were given no opportunity to even compete to do so. So at 9 p.m. on June 20th, DMAR and SMDRA shared a letter of intent to sell ReColorado to an external LLC. The fact that this deal was happening wasn't the only cause for concern either. The terms have left the ReColorado's leadership uncertain about their company's future. So I guess they're decoupling the MLS from the boards in Colorado, and then they're not just allowing ReColorado to go out on themselves. They're selling ReColorado to a private firm, to a private company. Shelley Vincent, vice chair of ReColorado, and also I think she's the employee broker of 2,500 HomeSmart agents in Colorado. She said, how am I supposed to defend the association memberships to my agents? It's a great point. She is moving her people to the Mountain Metro Association of Realtors, MMAR. She said, but this whole experience has left a sour taste. So this article was on Broke Agent Media. If you're a Colorado agent, drop in the comments what this means to you, for you. Is it meaningless, or is this significant to you? I mean, it would be significant for us if the MLS decoupled from a board. I think that would be great. I don't know that they would have to go out on their own or owned by a private firm. I don't know that I would care as an agent. But there are a lot of people that care, and I think those who do care may have a stake in it somewhere. But I want to know, just from regular agents, is it a big deal or not a big deal? All right, so let's look at some economic news. Oh, wait.
Hey, Ray.
Yeah, go ahead, Jack.
Does this have anything to do with Homes.com ramping up their little world? And is there a monetization play being made for data?
Wouldn't that be interesting if the private LLC was CoStar? I don't think CoStar is an LLC, though, is it? But maybe it's somebody that owns. Maybe it's a
player that either setting it up to be, or just more competition in that realm. I don't know. You'd have to do a lot to catch up with CoStar, that's for sure.
Now, CoStar is a parent company.
But I'm wondering why. Why would an LLC buy an MLS?
CoStar LLC, U.S.-based company that provides video surveillance solutions. That's not it. CoStar Systems LLC. I'm looking up LLCs. CoStar.
But just why would they do it? It just came to mind.
Well, I mean, it is a moneymaker. I think I think there's more money to be made on MLSs than there is to be made at the board level. Personally, I think the MLS is actually providing a service where in many cases the board service they provide is negligible. So I think boards really have to revolutionize themselves to show their value to agents, where MLSs, they just need to get connected. I need all the MLSs to connect and to go to, worldwidemls.com. That's all I need you to do, man. And I will pay for that membership so much money.
We could call it realtor.com.
That would be a great
name
for a
But
website.
I digress.
Maybe, I think, you know what? Oh, now that Area is out there, I wonder if Area is making a play to buy MLSs around the country. How rad would that be?
To make them one.
Yeah, that would be significant.
There's something deeper to that story.
Yeah, let's see how that one plays out. I need 10 foil for this one, because that's that would be right. Jason, if you're out there watching the show, contact me. Let's talk. But what a play would that be even if CoStar bought it? That would still be a pretty interesting play if they started buying MLSs around the country. They have the money to do it, I feel like. Area being a new thing, it probably doesn't have the funds unless it's got some private funding to pull that off, or some venture capital or something, but that'd be pretty rad. Okay, let's talk about the economy. We have this data kind of came out last week, but the home builders published it this week. Existing home sales slid in May. Existing home sales fell for the third straight month in May because of lingering high mortgage sales and record prices. Total existing home sales fell in May 0.7% to seasonally adjusted annual rate of 4.11 million, 2.8% lower than a year ago. Meanwhile, the share of first-time buyers fell to 31%, down from 33% in April, but up from 28% in May of 2023. A lot of ups and downs. I just thought the chart here was a pretty good one. So the blue line is the total. So then we have the red line that shows you the single family home sales, and then the green line that shows you the condo sales. And the single family, obviously, it's kind of trailing, or it's kind of in sync with the total axis because it makes up the largest number of transactions. But you can see where we are now in relation to where we were in, let's say, what would be similar, 2008, 2010. That's kind of where we are as far as the existing home sale units in the millions of sales. So we've had a big increase, and then we've gone all the way down to where we were in 2008. We haven't hit the bottom out of, what is that, 300? Is that 3 million units? Yeah. So, well, that's the total. I'm sorry, that's the total axis. I'm looking at the other axis for the units and millions of the SAAR. But interesting to me that it is down to those 2008 numbers when you see all the pundits and everyone talking about like, oh, it's different from 2008. It's not the same as 2008. I agree that the scenario is different than 2008. Where we are economically is different than 2008. But where we are as far as home sales go is the same. And you know how many more agents there are in the world now than there were in 2008? What is that's right. I would have looked it up on the NAR, but they don't publicly disclose the agent count anymore. But there's a lot more. So there's a ton more real estate agents now than there were in 2008. But the opportunity to sell homes is the same as it was in 2008. The pie is the same size, but everyone's slice is now a little bit smaller unless you're out there hustling. So that's why I wanted to share this, because of this chart really illustrates something I think pretty powerful in what we're experiencing as real estate agents around the country. Part of this reason is because housing affordability is so bad. How bad is it? How bad is it? It sounds like the old jokes. Prices rose in April 6.3%. Home sales, home prices are now 47% higher than they were in early 2020. Half of renter households spend more than 30% of their income on housing this year. So home prices, set another record in April, even as mortgage rates rose and supply of homes for sale increased. Usually under those circumstances, prices would weaken, but today's housing market is unlike any other in recent history. That is interesting. Normally you do see an increase in inventory because of so many people backing out. An increase in rates would cause some prices to weaken, not necessarily drop. I do think and we talked about this last week, the rate of increase of home prices is way down from what it was, but it is still going up. 2024 is closely tracking the strong start observed last year, where March and April posted the largest rise seen prior to a slowdown in the summer and fall. Heading into summer, the market is at an all-time high, once again testing its resilience against the historically more active time of the year. Is it super active for you guys? And some of my friends in major markets are saying that it's still multiple offers going above ask. It's still nuts. It is not that way in our market. I'm actually seeing some properties sell $50,000, $60,000 below where they're listed. So I think people are getting pretty good deals here.
It's still nuts in Southern California.
Still nuts in SoCal. Okay.
Yeah. It's slowing down though. There's a lot more inventory coming up. I mean, I haven't taken measurement in a couple of days, but it seems like I'm seeing more out there, and days on market is getting longer and longer.
Interesting.
Some price drops, but for the most part, the pretty ones are getting multiple offers and going way over ask.
If you have a house that's pretty, that is well priced, staged well, good photos, it's going to go pretty quick. But a house that is not priced right, man, it takes a huge hit immediately. It's a very price sensitive market. Let me see what else is on this list that we need to cover here. Homeowners are also facing a sharp increase in insurance premium. It's up an average of 21% between 2022 and 2023. Wow. Taxes are also rising, property taxes. So prices continue to be supported by an imbalance in supply and demand. Housing supply was already low before the pandemic because home builders had yet to recover from the financial crisis of 2008. Then there was a pandemic-induced run on housing, causing supply to drop to record lows for several years. Home builders couldn't keep up. Supply is now rising with an 11% increase in March. According to Zillow, it's 16% increase from April 2023. Let's see. That pushed total for sale inventory up 18% year over year. So the rapid and sudden increase in mortgage rates in April pushed housing affordability further out of reach. As a result, the share of listings with a price cut shot up to 22.4% in April. But here locally, it's 45%. Number of listings with the price drop market is 45%. It's not a 40. So some people misreport this number and say 45% price reductions. That's incorrect. It's not 45% off of where they're listed. It's 45% of listed homes have a price drop.
Hey, Ray.
Yep.
And from Portland.
How are you?
It's funny because good. We are in Portland. July is usually like slow, crickets historically. But I just accepted an offer for $75,000 over on my new listing, my new rehab project.
Wow.
With four really good offers. The thing I'm finding about the houses with price drops, as soon as they drop, they go. So they go like within a day. It's always funny to me why agents don't just reach out and say, hey, will your clients take a lower price?
Yeah. Well, we've had some recent price drops, price reductions. And mainly it's because our sellers said, I don't want to list it that low. I want to list it at this price. And we said, okay, if we list it at that price and nothing happens, here's everything we're going to do for you. We're going to try to make the market think it's the best thing since sliced bread. But if nothing happens, we need you to price drop in 2 weeks or in 1 week, depending on the house and the location, all that stuff. And most of the time they're agreeable to that. And if nothing happens, we say, hey, we tried it, and then they'll drop. But sometimes even in this market, I had a buyer the other day say, this house has been on the market for 4 days and doesn't have a contract. I'm like, wow, no, this is not that market. This is a totally different market now. But housing affordability is still a big issue. It's also an issue for renters. So as we said in that earlier report, 30% or renters are putting about 30% of their income towards their monthly rent. Here's a report that says renters must earn $66,120 to afford the typical U.S. apartment. See, that's not terrible, except the typical renter makes $11,000 less than that. Wow. The typical U.S. rental household earns an estimated $54,712 per year. That's 17.3% less than what they need to earn to afford the monthly payment. Here's the chart that shows the U.S. renters must earn $66,000 to afford a typical apartment. I mean, this just goes to show you how much people are stretched. And is this taken into account? I know this is taken into account the income comparison, but is it also taken into account the increase in other expenses in the last, 3 years? I think it's up 30%, just the cost of living. Rents are growing at a snail's pace compared to rapid increases we saw during the pandemic and are unlikely to soar again anytime soon. As a result, wage growth should continue to outpace rent growth in the coming months. It's been doing so since 2022. So they are looking for this gap to get smaller. I think that's all I got on that. This is on Redfin, by the way. They have a huge chart there that shows the different metros and the income required to afford. New York is number 1 on the list, $119,120 to afford the median priced apartment. The bottom of the list is that Dallas, Texas? $61,160. So I think more people are going to be moving around the country. I know we had a lot of people moving because of the pandy, but I mean, it used to be that if you can't afford to live in one area, you just did not stay in that area. You would move to a different area. And I don't know why we're not seeing more of that rapidly around the country. It seems like people are just trying to stay in these very populated, very expensive areas, and I don't get it. I wouldn't do that. Okay, let's get back to mortgages. All right, both mortgage rates and weekly mortgage demand are stuck in place, suggesting a slow summer housing market. After a weaker than expected spring housing market, the summer looks much better. High home prices continue to rise. Mortgage rates aren't coming off of recent highs. Oh, it looks no better. Let me reread that for you. I'm sorry. I didn't mean to get your hopes up there for just a second. After a weaker than expected spring housing market, summer looks no better. Sorry, I misread that. High home prices continue to rise. Mortgage rates aren't coming off of recent highs, and consumers are unimpressed by the small increase in home listings. Applications to refinance a home were unchanged, but were still 26% higher than the same week a year ago. That's interesting. Lower rates, however, were still not enough to entice refi borrowers back. Most continue to hold mortgages with considerable low rates. Yeah, that's Joel Kahn, Mortgage Bankers Association economist. Applications for a mortgage to purchase a home increased 1% for the week, but were still 13% lower than the same week a year ago. So we did have a slight week-to-week increase, but not much. Purchase applications did see a small increase after adjusting for the Juneteenth holiday. Government purchased loans, primarily FHA and VA, saw gains more than 2% over the previous week as home buyers in those segments sought to take advantage of recent rate relief. There was another article. Well, it wasn't an article. It's just a story on CNBC that said there seems to be a spike in the top of the market where more high-end property. I think that is likely just due to affordability. It's saying that, I hope I'm not breaking up too much. It is showing that I am breaking up on the stream. So, all right. So the housing market, Wait, is this out of order? Okay. More listings and lower rates should boost sales in 2025. Let me share this tab. This is from Inman. As a weaker than expected spring has prompted Fannie Mae economists to cut their forecast for 2024 home sales to the point where it's now looking like this year will hardly be better than last year. But more listings are starting to come onto the market, particularly in the Sun Belt, and the economy is cooling at a pace that should help mortgage rates stay on their current downward trajectory. Yeah, but nobody is predicting that it's going to go down. I mean, at the beginning of the year, everyone was predicting 5.5 at the end of the year, and they were expecting 3 or 4 Fed rate decreases and or rate cuts, and that has not happened. All right, Ellis. Patrick Ellis says, slight glitch for a second, otherwise clear. Okay, cool. Thanks for watching the show, Pat. Additionally, the labor market is showing signs of gradual slowdown with the unemployment rate creeping up to 4% in the June report. So this sounds counterintuitive, but that's what we need. We need the unemployment rate to go up in order for the Fed to be encouraged to cut rates. So we need the unemployment rate to go up, which sounds counterintuitive. But when that happens, that means there's less money in the economy. It's less money for expansion, and the economy will start to shrink a bit, which then pushes rates downward to get more people to spend money and expand. So that's the Fed has a 2-part job. First part is to keep everybody gainfully employed. Second part is to prevent inflation. If you have 100% employment, that means everybody's got money and then starts making orders on everything. And then all the producers can't produce all the orders, and then the price goes up. That's inflation. Okay. Let me jump right into the next article too, because this is the one. Housing market to remain stuck until at least 2026, says Bank of America. The housing market is unlikely to recover for several years, and affordability won't get any better unless the recession hits, according to Bank of America economists. In a mostly pessimistic outlook on this sector, the bank sees a variety of factors lining up against both major improvement in sales and a drop in prices that would bring younger buyers back into the market. Among them are pre-pandy related factors that saw a rush of buyers come into the market around 2020 and 2021, driving a dramatic spike in sales, coinciding with an inflation burst that goosed interest rates to their highest level since the turn of the 21st century. Yeah, I mean, it's echoing what we've been saying. They're just saying it's going to go into 2026. I think if you told most people that at the end of 2024, rates would still be around 7% or high 6s, I think most people would push their predictions on out to a recovery in 2026 to where it feels more normal. I think at the time when everyone was making the predictions that, hey, it's going to be normal by 2025, that was with an assumption that rates would be at the 5% range at the end of the year. After a surge in housing activity during the pandy, it has since retreated and stabilized. We view forces that have reduced affordability, created a lock-in effect for homeowners, and limited housing activity will remain in place through our forecast horizon. We think it could take 6 to 8 years for the lock-in effect, or the dearth of transactions in existing homes, to go away. The wide gap between current mortgage rates and effective mortgage rates means most homeowners are unwilling to move unless forced. So we did an open house. We did 2 open houses this last weekend. One on Saturday, one on Sunday. We didn't have very many people there at all. It was abnormally small compared to what we normally have. But of the people who came, all of them, 100% of them, were very serious buyers. And that is unique. You normally have a bunch of tire kickers, people that are just considering, maybe we'll sell, maybe we won't, maybe we'll buy, maybe we won't. But the 3 people that came were like, we're going to buy a house. We need to buy a house. And some of them weren't ready. You had to get them approved and all that kind of stuff. They had no idea what to do, but still they were ready. Here's an existing home sales chart. that shows January of 2019 to May of 2024, you see this drop in existing home sales, 4.09 million. May of 2020, we went all the way down to 3.85 million in October of 2023. When that was the first time when rates hit the 7 and 8% again. And now we are at, in May, 4.11 million. So if you go to May of 2023, we were at 4.23 million. So we're a little bit behind where we were last year. And the source for this is National Association of Realtors.
We were on like a 10-year solid run.
Yeah.
And then it felt like it was about to get soft, and then the pandemic hit. And what I'm seeing in Massachusetts and in my own town is that is inventory starting to stack up. We have the most inventory in the town and in the state by far that we've had over the past 4 years. And that is where we start shifting to a buyer's market, and buyers are more influenced with lower prices versus waiting for economic factors to start, which is certainly going to help to start influencing rates.
I feel like this is real similar to the beginning of 2019, maybe towards the end of 2018, where the major markets, like Southern California, the real popular areas to live, we're still in these multiple offer situations, but smaller areas like mine, we weren't really calling it a balanced market because buyers were getting some off the price and their closing costs paid. And we are seeing that pattern. Like our buyers are getting great deals right now. They're able to go below list price. They're able to get their closing costs paid. And where the hang up is currently is that sellers are listing their homes pretty high. So we're coming in at reasonable market values, but it's still way below where they're listed. We're getting closing costs paid, and then we get into the inspection. And when we're in the inspection, that's the part where we're seeing deals fall apart because the buyer has really high expectations for condition. The seller has really high expectations for their net, and those are conflicting. And once the buyer says like, hey, here's the money we need in order to fix this, here's what the seller's like, I'm not going to do that because I came off my list price to market value and I'm paying your closing cost. So I'm not going to drop any more. And that is the current conflict that we're seeing over and over. And it usually lasts for a month or two, and then the market kind of works itself out and figures that out. But in a shifting market like this, I feel that's where we are. We're back to 2019, 2018, when a lot of the rest of the country in very popular areas, you guys are still seeing multiple offers of great properties. Other properties are sitting. In my area, you might get one or two multiple offers on a great property, but for the most part, it's, one or two offers here and there, and we're able to get some good deals for our buyers. So I think I remember thinking, and I was talking with Dan back when he used to host the show with me, he would tell me about these 10, 20 offer situations. And I had been doing real estate since 2007, and I'd never been in a situation that got 10 offers. I mean, that's crazy to think about getting 10 offers. Then I lived through the pandemic, and we are getting crazy number of high offers throughout the pandemic. So that was my only experience with that in my marketplace. A normal marketplace, you'll get a couple of offers on a really phenomenal property that's priced well. Otherwise, you just won't. So it's interesting. It's familiar to me, but it's not recently familiar to me. And so it is taking some adjustment on how we look at things. Hey, Matt LaMarche is here. What's up, Matt?
What up? How are you?
Good, man. Welcome.
Sorry for the delay.
It's no worries. We're talking about markets around the country and what we're seeing. And it's still one of those hot markets where it's, multiple offers on good properties that are listed, where you have like 20 and 30 offers, or has it gone down to just a couple?
It's so weird because there's like two different markets happening simultaneously. There's some properties that are flying off the shelves. I made an offer on one on Sunday and I got 3 other offers, and we went 50,000 over, like 10% over, and we didn't get it. and I think a lot of it was our terms, not necessarily the price, but move-in ready, beautiful home, great area, schools, the whole nine. And that's the minority at this point. The higher price points, our luxury kind of starts at like 1 million now. So that's 758 and up, obviously depending on the area. Seems to be sitting a lot longer than it should. And I don't know if that's just sellers' expectations and the agent's inability to communicate their value in some crossroads.
Yeah.
But yeah, it's weird. It's really, really weird at the moment.
I'd completely agree with that. I think there are pockets where there is strong demand, and there are pockets where there isn't, and which is much different from the entire market being up or down. That's a great observation, Matt.
Very interesting. Well, we're talking about housing affordability, so you have to know that Christina Smallhorn's going to drop in. What's up, Christina? How are you? She's over watching on YouTube. Yeah, I mean, it's what, and kind of on that note, actually, Christina, they're building a tiny home development in the county for homeless folks here. And it's done through a charity and everything, and it looks, pretty on the up and up. My only issue with it is that the homes they're building, a lot of people would want to buy in and live, but you can't get a loan for that kind of home in this market unless it's some kind of specialty loan or something. So like a normal bank is just not going to give the money. But that type of affordability or what people are looking for, most homes that are under 120,000 in our marketplace need a lot of work. So if you're a first-time home buyer in this market, you used to be able to buy a pretty good home for $150,000. It was great pre-pandemic. And now it's just so out of reach where, for a good first-time home buyer house in our market is 250,000-ish, maybe 200-ish. Maybe you can find something pretty good that doesn't need a ton of work. But the condition of homes in the lower 1/3 of the market, it's not good. So but we're all between kind of a rock and a hard place right now as far as that goes. Christina says that can work if done right. I agree with you about the new loans for smaller homes. They need a loan for smaller homes and alternative materials. Like, let me build a metal home and get a loan on it instead of saying, no, we can't give you that loan because it's built with metal. All right, so let's look again at the typical U.S. home. Speaking of tiny homes, houses are shrinking around the country, kind of. So this is where the thumbnail comes from for today's show. The typical. Did y'all see the thumbnail? I'm gonna have to. Yeah, you saw the thumbnail. If you're watching on YouTube, you saw the thumbnail. The typical U.S. home in the U.S. is shrinking. Here's what that means for buyers. So in the first quarter of 2024, a single-family home, newly under construction, had a median 2,140 square feet of floor space. That is down from a median of 2,256 square feet in the first quarter of 2023. This new figure makes for the smallest new homes since the second half of 2009. Isn't that interesting? The National Association of Home Builders found in a May analysis. New builds have been shrinking since 2015 when the average home size peaked at 2,689 square feet. Wow. The only year home sizes have jumped in that time span was 2021. So homes are getting smaller. Why are homes getting smaller? Because if builders are building homes bigger, people can't afford them. So to get the cost down of the homes are getting smaller. Takes less materials, less labor. About 28% of polled buyers recently purchased a home between the sizes of 15,000 to 2,000 square feet, while 26 purchased a home between 2,000 and 2,500 square feet. Isn't that interesting? So 40, oh man, terrible at math, 50 4% of buyers bought a home from 1,500 to 2,500 square feet. Another 16% bought a home that's 1,500 square feet or smaller. So actually, you had 70% of people. Is that 70%? 70% of people that bought a home from 0 to 2,500 square feet. Wow.
So I hate to, sorry to keep jumping in, but
No, that's why we do the show, Jack. We do the show so people will jump in and talk about it.
the one thing that has disappeared in my market is when a fixer-upper property of any size comes on the market. We used to have a handful of guys that would be the flippers, and they're non-existent. And I was talking to one, I talking to them all the time, but my first conversation asking them why is cost of materials, and the numbers just don't play out anymore for them to come in and make a buck on a flip. Soft costs and cost of materials have just gone up so much that the risk has overtaken the reward.
Yeah, I think that's that, and a lot of them were ushered out of the market by these big firms that were coming in and doing the fast flips. So major markets, you remember those, we said offers.com, Open Door, whatever they are, they're not competing with real estate agents. They're competing with your local flipper. We said that. And they entered into markets and they said, we're going to pay more for your home. We're going to flip it and put it back on the market. And they did that and they lost money. And a flipper was no longer in competition with someone who was out to make money. They were in competition for someone that was out to show expenses. And they can't compete with that. So I think those companies really hurt the flipping market. And this may be time for the flipping market to come back. But you're right, materials, they've got to settle down. We did an experiment. I may have already shared this on the show, but we did a team meeting at a flooring wholesale place. And I guess they do flooring and cabinetry and all kinds of stuff, but it was a wholesale builder place. Because as pros, we can register there and then save some money for our clients. So we went there, did a field trip for our team meeting, and they took us all around. And I looked at the flooring that I had bought for my house that I'm in. I flipped my own home, and the flooring alone, not counting the labor or anything, the flooring was 4 times higher than it was when I put floors in this house in 2019. That is, or maybe it was 2018. That is insane though. For flooring to go up that much and then to stay there. I know it went up during the pandy because it was hard to get materials in and all that, but the fact that it's staying there is wild. So I mean, it does leave room for companies that can do it less expensive, but still have pretty good quality. It does leave room for new companies with new products to enter the market. So that's good. But there has to be something done with materials if they're going to make a comeback. And if we're going to keep building costs down for people to purchase bigger houses or even just a regular house. Olivier was saying that folks in Canada aren't getting the big yards and all that stuff anymore. That's all changed. Go ahead, Jen.
Regarding the flippers, I'm a rehabber. I'm not a flipper. There's a distinction. We see at least where I am, whenever the market gets hot, every Joe Blow thinks he can flip a house. They don't have a crew. They go to Home Depot. They put out a really crappy product. They end up with tons of holding costs. So for a couple of years, they buy up everything, just everything. So we have a really hard time finding them. But then after a while, after a couple of years, after they realize, oh, this isn't as easy as I thought, and they've lost their butts, then they realize, and then they go back to the kiddie pool. Yeah. So that's what I found. So we are just starting to be able to pick up houses that, with still meat on the bones on the MLS.
Yeah. I could see that. I mean, we are getting better deals for our clients right now, so there's no reason why we couldn't get better deals for investors. That's funny that you call it a rehabber. At first, I thought you said you were in rehab. I was like, whoa. All right, so Christina Smallhorn's got a good comment. She said, younger people are not opposed to a smaller home. They don't need a formal dining room or want it. That is true. One of the interesting things in this conversation, I think that's missing is the office. So you remember just a couple of years ago when people were like, hey, you can't leave your house. And if you leave your house, you have to wear a mask and bathe in Clorox and all that jazz. When that happened, there were a lot of people that left their office and they started working from home. Many of them went to second home markets and started working from their second home market because they could work from anywhere in the world. And for a good solid 2.5 years, almost every person that I dealt with wanted 2 bedrooms and an office, or they were trying to get that extra bedroom to make into a home office, or some space, extra space in their primary bedroom for a home office. And I thought that was really interesting because it doesn't seem to be that way anymore. You know, people were converting their dining rooms into a home office. I'm not dealing with a lot of buyers that are looking for a home office anymore. So that either means that they're going to work or starting to go back to offices, or that their work has just changed. But you would think that with COVID and everything that happened, there was a stint where it seemed people were wanting a larger house. They were wanting a house with a pool. That way they could go there and not rely on the neighborhood pool being open during a pandy. They were wanting a tennis court. They were wanting more stuff at their own home. And that seems to have gone away fairly quickly. I think people, as they return to life, maybe they think, well, that's never going to happen again. And if it does, I don't think anyone's going to obey it. So let's just get a regular house and use the neighborhood pool and use the tennis court because it's more affordable. Maybe it is affordability that's just pushed that out. You know, when people could get an interest rate of 3%, maybe they were more apt to spend the extra $100,000 for all the extra stuff they wanted. But regardless, it has been a pretty swift change from the pandy home buyer to today's home buyer that is just looking for enough space. They're not looking to max out the space, and they're looking for something that they can afford easily. So it's a very different buyer in a very different market right now. Okay. 40%, chasing homes. What's up, man? So was about to say affordability. Let's see. Price drops hit new high. We kind of covered this a little bit, but this is a new report from Redfin, though it kind of echoes what we talked about last week. For some reason, my connection is showing that I'm super stable, but over on the YouTubes, it's hopping around a little bit. So sorry, guys. All right, so home prices hit a new high, but buyers gain power as stale listings pile up and price drops become more common. Pending home sales posted their biggest gains since the beginning of March. Pending home sales fell 3.8%. Buyers are backing off largely because of housing costs, which we've already talked about. The irony of near record high housing costs causing buyers to back off, and enough have backed off to give buyers who remain more negotiating power for certain homes. That's the key phrase I wanted to read today. This is the irony of it. This is what I think you guys should put on your social media. This is what I think you should tell your home buyers. Yes, there are a lot of buyers that are backing off right now because of rates, but because there are so many buyers backing off because of rates, the power of negotiation is with those buyers who are currently staying. And that is interesting. New listings are near historic lows still. Many home listings are becoming stale. It says sitting on the market for 30 days. Wow. Y'all remember 120 days on market? I remember that. A few years ago, I'd have never told a seller they need to freshen up and paint and fix their furnace and make sure the roof is up to date before putting their home on the market. But now I tell them to make sure the house is pretty as possible. Buyers are still out there and they're willing to pay today's high prices, but only if the house is in really good shape. And this goes back to the conversation I was having earlier about our market and what we're seeing with people just wanting everything to be in extremely good shape, extremely good condition for the price they're paying. But the question is, will there be major markets that get a 40% decrease in home values? One of Christina Smallhorn's favorite people was on CNBC. I feel like he got lucky. I don't know how he got to CNBC. It's almost like CNBC never looked at his other YouTube videos. So housing and pandemic boom towns up to 40% overvalued, says Reventure CEO Nick Gerli, Gerli. So if you look at this guy's stuff, this is one of the housing crash bros that Logan Matashami always talks about and that I kind of refer to. He's been on YouTube for years saying the market is about to crash, 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 about to crash. It hasn't in all those years that he's been saying it. But he is he's showing the world that a market like Austin is crashing currently. The Austin real estate market is crashing, he says. And one of the reasons he says it's because it's overvalued. So I only wanted to bring up this article to bring attention to who the guy is. Y'all can look him up, watch his stuff. He has some kind of app, Reventure, that talks about housing data and stuff. But he said he had a comparison to 2008, and he said, a lot of people are saying it will never happen again like it happened then, and yet we're looking at data that's similar to 2008, which is correct. We are looking at home sales data that is are low as it was in 2008, but the situation regarding inventory, buyer demand, and just overall buyer health is completely different. You don't have buyers that are leveraged so much and then have taken out loans that they shouldn't have qualified for. You just don't have that in the marketplace right now. So Christina says, he will be right eventually. If you keep saying it long enough, maybe one day. But in many lifetimes, had never seen a crash like we had in 2008. And I don't know that we will ever see another crash in my lifetime like we saw in 2008. Because home values have always gone up. And the reason why home values are different than any other commodity is because everyone has to have a place to live. And the population isn't yet decreasing. So until the population starts to decrease massively, then I would say that home values are going to continue to go up. And if you tell me that home prices are going to go down, I'm going to tell you, you're probably looking at current prices, list prices. Those are going to fluctuate up and down. But when you look at the long-term home values, those are going to continue to go up in most markets. Now, you may have some pockets here and there in which home values dip, but that's why investors look at specific markets, because you might have a specific market condition in Detroit where automakers leave Detroit. Well, that's going to cause a glut in the housing market because people are going to leave there. And if that town could recover, or if other industry is coming in, then you buy ahead of that, then yeah, it's like trading stock. But for the most part, there are more people in the world every day, and housing has slowed down. So supply is still very short of what we need in order to satisfy demand, if demand was at a 5% interest rate. So at the current interest rates, looks like we have enough housing to supply it. It looks more balanced. It's not crashing, but you are seeing current listings reduce their price. But it's not that the home is 40% overvalued. So watch out for the sensational list, especially the ones that make it to CNBC. Christina said home prices may see a drop if people can't afford the home insurance. It's criminal what they've increased mine by. Yeah, that's one of the things. Christina said his app, it pains me to say, is actually good. I do like the data in the app. I'm not a member or whatever, but I like the data. I just think he interprets it wrong. It's good data. It's interesting data. I just think he's interpreting the data wrong. But she says home prices may see a drop if people can afford the insurance. There are some variables in the housing market that are hitting affordability kind of from all angles. You have the increase in taxes, you have the increase in insurance, you have the increase in monthly payment, and you have the increase in existing home sale values, and you have an increase in materials and labor for new. So will home prices continue to go up by 6%, 12%, 50% a year? No. Will they go up by 1% to 2%? That's what I think. I think we're going to see a home price gain slow to where if you purchase a home, you're going to need to start considering it long term. Are you going to stay in this house 3 to 5 years? If so, then the 3 to 5 year period, you could probably make your money back, live in a house you want to live, alter it, improve it a little bit, and come out better. But if you're going to leave in a year or two, no, you should probably rent. You're probably not going to make any money on the sale unless you get an incredible deal whenever you purchase. Christina said increase in HOAs too. Yeah. There's been a lot of affordability problems, but I still think that it's not going to make up for the glut of supply. Oh, good. Ms. Jones. She said I introduced her to Logan Matashami. I love his weekly recaps. He's a good guy. What did you use to come on? It wasn't your full name, Delcinia. It wasn't your full name. It was something else. Was it D? D Jones? I think that used to be your YouTube username. All right. Well, that's all I got for this week, guys. Thank y'all for joining me. Yeah, D. See? I knew that. Thanks for joining me, guys. A lot of news this week. Don't forget to do all the YouTube subscribey things. We're trying to get to 10K. We're at 7 something now. So don't forget to go over to YouTube, subscribe, hit the bell so that you can be notified of whenever we go live. And if you want the audio recording of this, just look up This Week in Real Estate or T-Wire or both, T-Wire Podcast, and just check it out on your favorite podcatcher and download it there and review it. So thanks everybody for joining us this week. I'll see you next week. Bye.